Hi there. So far in this video series, we've looked at what's happening to grain prices around the world and what we expect in 2022. We looked at what's happening in the farm inputs side of things, and we also looked at what's happening on the domestic demand side of things in the dairy sector and the cattle and feed sector. Today, what we're going to look at is what are some big picture external factors that might throw our base cases off the scenario that we think is most likely. And to help us do that is our new general manager for Rubber Research Australia and New Zealand, Stefan Vogel. Stefan, how are you doing today?
Very good. I think let's dive right into it. The big ones we see that can disrupt or benefit the market in Australia, depending on the direction, is geopolitics. Trade war between the US and China right now is not a big factor. But if it would come back again, I think it would require the US to find other buyers in the market. And that means they would knock more heavily on the importer side in Asia, which wouldn't be a good thing for Australian cargoes. On the other side, we also need to monitor what happens between Russia and Ukraine. Clearly a very important export region for grains, for oil seeds like sunflower seed, for fertilizers, for energy. So with that, we would expect on the one side prices for Australian wheat and other exported goods on the agri side to somewhat rise because likely the export flows out of the Black Sea region would be reduced. On the other side, it would also likely mean that our farm costs here increase because the energy side, as well as the importance of Russia and Belarus in terms of fertilizer exports, is big. And with it, we would see increased farm input prices. The next one to look at probably is the FX rate. We need to see when interest rates are increased. Inflation is still a very, very big issue, and clearly raising interest rates is one of the ways to fight inflation somewhat. And with that, we would see clearly an impact on the FX rate. If the Australian dollar gets weaker, it usually is a good thing for our exporting communities over here and helps the flow of goods. The next one to watch is probably labor. It is, in my mind, a bigger issue in Australia when you go further down the chain. So clearly for everybody in retail, everybody who distributes food, we see the shelves are somewhat empty still, and there's a lot of issues on that side. On farm, yes, we're missing out also on labor, especially that also the labor from immigration. We had last year one of the first years ever where there was a massive amount of net emigration. So a lot of people leaving Australia, not coming in again with the rules. That is hopefully changing in 21, that we get the labor on farm. But also in other regions, the market is struggling, especially if you look into, for example, the palm oil sector. These guys have struggled a bit. And if you look at palm oil prices, they are high. So we can't afford to lose a lot of volumes. But if palm oil prices are high, it usually means good things for our Australian canola over here. And the last word maybe on freight. If you look at the bulk freight rates, they were very, very high last year in October, risen to 11-year highs. They've fallen dramatically since. However, despite this massive decline, they are still higher than the 5-year average, higher than the 10-year average. So with this, our freight is still more expensive. I think we will not fall quickly to the average levels. However, there's also not a lot of expectations out there that we will see this rate of freight rising dramatically again. So with that, we should probably plan for freight rates above the average terms, but not as high as they were last year, which usually means we can go still to Asia. However, our competitors from further away also find a cheaper way than just 6 months ago to get into Asian markets. So we have still continued market. Freight may doesn't help us there in these regions. Container, for those who are exporting pulses, for example, container freight is still extremely high, about 5 times as high as they have been historically. And with that, I think 2022 will be a year of continued high rates on the container side. It takes time for that market to clear up the backlog that we have. It is a global issue. It's not only here in Australia, it's not only in Asia, it is a global issue. And getting this whole machinery working perfectly again will take time, in our view, more than just 2022, probably even well into 2023 or beyond.
Thanks, Stefan. Well, those are the important factors to watch for. Remember that the Ukraine and Russia situation is a potentially very large deal. And if you want to learn more about it, have a look on either the Australian or agri-commodity market rubber research podcast channels if you want to listen to more. But that's it from our end and for this video series. So thanks for tuning in, and we'll see you next time.